Hello and welcome to the week ahead for the week starting Monday, the 25th of May. The sun is shining here in London and Arsenal have won the league. So all is good for financial markets. Of course, we've seen some volatility as we try to guess exactly what the direction of travel is between the US and Iran. Of course, the long-term trajectory is upwards as long as we don't see a resolution to the closure of the Straits of Hormuz. Of course, we do continue to see little tidbits of information that give us hope and then drive that hope downwards once again. So once again, Iran's going to be a key theme for the week ahead. But alongside that, we also have a raft of data coming out of the US alongside a rate decision from the RBNZ and inflation out of Australia. So first and foremost, here are the major economic events according to Trading Economics. And you can see there's not a huge amount of them that are sort of the top tier events. Really, we've got Thursday and Friday. Thursday is all about the US with the core PCE price index, the durable goods, personal income, personal spending. Then we've got consumer confidence out of Japan on Friday, inflation data out of the Eurozone, France, Germany. And then we've got GDP coming out of Canada. So let's kick off with the US. And you can see that things are relatively busy when you look at the US, most notably, as we've said, on Thursday. But before that, we've got the Chicago Fed National Activity Index, the Case-Shiller Home Price Index, Consumer Confidence, and the Fed Manufacturing, Dallas Fed Manufacturing Index on Tuesday, the weekly ADP reading on Wednesday. And then on Thursday, really, it's all around the likes of the inflation data on the PCE front. I would say core PCE, but it's not only about the core PCE metric because, of course, the headline or durable goods figures are also worth bearing in mind. And also keep an eye out on the likes of personal income, personal spending. How is the US consumer right now? In terms of the inflation data, really, we've got the core PCE, but also there's just standard PCE figure to bear in mind because essentially you've got energy issues at the moment. And whilst down the line, you're likely to see, as many call it, sort of second order effects. So your first order effects, very clearly, sort of energy prices on the rise. Second order, third order effects. So when that rise then impacts something else, and then that turns into another wave or another source of inflation. And so that means that by and large, if you're looking at where inflation shows up, you're probably first and foremost going to see it in something like PPI input prices. Then you see it in PPI output prices. Then you see it in headline inflation. Then you see it in core inflation. So really it sort of transmits through, the prices being served up to businesses, then the prices that businesses then put onto consumers, and then sort of wrapping up where the consumers are seeing it. They're seeing it in the areas where the energy prices are particularly showing up, which is headline inflation, sort of PCE rather than core PCE. And then once you see the second order and third order effects, where businesses are passing it on to consumers and then you're looking at the core figures as well. We haven't necessarily seen a major uptick in terms of core CPI, core PCE, but certainly this is where we want to be looking in terms of the potential source of volatility in terms of the economic calendar, because if we do see a particularly strong surge in terms of inflation, then of course you're then in a position where you think the Fed's going to have to hike rates. And of course, we've just come off the back of hearing from the Fed with their minutes where essentially they're not only saying that they're going to stand still, we're starting to move towards a position where we think that they're going to be hiking rates. And in the past, there had been a feeling that the US would be protected to a greater degree than, say, the Europeans, and that the Fed would be more dovish. Of course, Walsh coming into the role on the ticket of having to do the bidding of Donald Trump. Well, he's being given a very, very difficult set of circumstances to operate within if he's going to drive down interest rates. Now, what I have here is the prices paid element from the two ISM metrics, so the ISM services and the ISM manufacturing prices paid elements. And then I've overlaid it with the 3-month annualized growth rates for core PC, which is purple. And then that red line is the headline PC, so just PC. So what I thought was interesting about this is that this sort of gives us an idea of where we can look for, aside from inflation, sort of ahead of those inflation metrics, where can we look to see where inflation is going? And the good thing about the ISM PMI readings is that they also break it out in terms of, from a numerical standpoint, what are the prices paid or the inflationary elements of that report. So you have sort of new orders and employment, but we also have prices paid. And what can we see here? Well, the services is in light blue, the manufacturing is in dark blue. As we can see, the big move has been on the manufacturing side of things. And by and large, where we're looking in terms of the inflation side of things, it's been the headline inflation, the headline PCE metric that has been surging over recent months. And if we look in terms of market expectations, you can see the core PCE expected to remain at 0.3. So again, relatively under control. The headline metric, there it is at the bottom, 0.7 last time, 0.5 this time around, with the year-on-year figure up to 3.8. So we are seeing inflation. We're not necessarily seeing that sort of second order effect coming into play where we start to see core inflation impacted. And of course, then it starts to put the question over to the Fed, do you only care about core? Do you disregard any energy related inflation, or are you willing to tighten monetary policy off the back of a rise in headline inflation and not core inflation? In terms of the markets to watch, of course, we're really looking out for the US dollar when it comes to things from a sort of inflationary standpoint. We can see here that we sort of saw that initial surge around the beginning of this crisis, and then we've seen this bit of a pullback since then. If we're looking at this and say overlapping the likes of, say, Brent crude, let's just put Brent onto that as well. And so what we can see here is that between, this is the inception of the crisis. Let's go on to say the 4-hour chart. So here we go. This is where it all kicked off. So very closely correlated. So essentially, higher oil prices means higher US dollar, because the expectation is that the Federal Reserve are going to have to hike rates or be in a lot more hawkish. So as we move closer, I would say that this correlation still does hold, but generally not as well as we have been seeing. So you're seeing here, like, we're having periods where it's sort of coming away to a greater degree, right? So greater divergence or inverse correlation rather than that very close positive correlation. More recently, you can see here that sort of oil prices drifting lower, but the US dollar holding up. And that really is on the perception that, well, the damage by this point has likely been done. And so inflation is going to be well above target for a while now, just because of what's happening right now. And even if they do sort of draw a line under the conflict, there is a good chance that we're not going to see rate cuts for a while now. So the US dollar's holding up very well. And certainly if we do see, I was saying that the correlation sort of coming away at the moment. If we do see a pop in terms of oil, that correlation is going to be very close, because I think the US dollar is going to rally with it. It's just that this is sort of holding up, in my mind, in anticipation for another move towards the upside for oil prices. So the daily time frame, we can see here that we've sort of been stuck within this sort of wider range, sort of below the 100 mark, and then above the sort of 96 zone. We've pulled back into the midway point of that, and we're rallying up into this area of resistance, sort of 99.34. We're sort of challenging that level, but I think there's a good chance that this essentially is a double bottom formation. We project that up towards the top end of this resistance zone, up above that 100 mark. So it points towards further upside coming into play. Like I said, really a rally for oil prices would help things on its way. If we suddenly saw a breakdown, a breakthrough in negotiations, it's worthwhile noting that that's probably going to drive the likes of oil prices, but also the US dollar towards the downside. But I think we've kind of reached the point where people are a little bit skeptical about any of these breakthroughs, because half the time you'll hear an hour or so later that it's not actually true, and the source of this breakthrough is false. So there's a lot of market manipulation at the moment, and a lot of it's coming from Iran and coming from the US, as people try to drive markets in whatever direction they want. So yeah, as it stands, we've seen that rally. We're sort of creating that higher high, higher low. You can see it a bit better on the hourly time frame. So as long as we remain above that sort of 98.96, then the bulls do remain in charge here for the US dollar index. Next up on the economic front, we're going to be looking at Australia and New Zealand all in one. Thankfully, their flags look almost identical. So you can see on the left-hand side, we've got to rely on the letters to know what we're looking at here. But essentially, the main theme really is Wednesday. We've got inflation out of Australia. We've got the RBNZ interest rate decision from New Zealand. And so inflation really has been a major issue for Australia. And as you can see here, the expectation is another 1.2 worth of inflation for the month of April alone. So taking the year-on-year figure from 4.6 to 5.1. So Australia has a major inflation issue. And that, of course, generally drives higher interest rates. They've hiked for 3 meetings in a row now. And so where you're seeing a RBA that's hiking rates and an RBNZ that is, as you can see here, expected to keep rates steady. So there's the expectation of further upside for the Australian dollar against the New Zealand dollar. And ultimately, if we see what is expected here, it just points towards more of the same for that currency pair. So if we saw 1.2 for the headline inflation, if we see the RBNZ keeping rates steady, I think the likeliness is that we do see bullish price action for the Aussie against the Kiwi. Here's the outlook for the RBNZ. Nothing this time around, 27% chance of a hike, but most likely is that we'll see them pause. Then a hike in July is anticipated, but beyond that, maybe we see another hike at the back end of the year. So potentially 2 more hikes or 2 hikes for the remainder of this year. In terms of inflation out of Australia, you can see here a hefty 1.1 last time around, 1.2 anticipated this time around. You can see a few months ago, we saw another figure that was around the sort of 1% mark. So we've been seeing some pretty strong inflation numbers recently. And that line highlights that sharp upward trajectory we're seeing for Australian inflation. So out of all the major economies in the world, you would say Australian inflation really is taking off to a greater degree than many of the others. And therefore, that sort of points towards a need to look at the Aussie dollar once again. And this is something that we've been, talking about for a long time, the Aussie dollar against the Kiwi dollar. And certainly, despite the fact that it's gone to the sort of monthly time frame, you can see that we've been sort of exiting this sort of long-term consolidation in a very strong bullish mode. And you can see on, say, the daily time frame that we've now entered this phase where we're just clearly creating these higher highs, higher lows, just nice calm movements towards the upside. Now, notably, we've come into this deep retracement here. I think it's gone beyond any fibs, quite frankly, but we'll draw it on nonetheless, just to show you that it's done that. Deep retracement, there we go. So we've come beyond the 76.4 fib. We're back up around that 61.8 fib. For me, this pullback is likely a precursor to the bulls coming back into play. But essentially, if we break the 1.212 mark, then that theory is essentially defunct. Essentially, if you're looking at, say, the hourly time frame, what's notable here is that we've come into this pullback. So we've rallied into that new high. We've pulled back into an A, B, C retracement, just a very strong A. Then we've rallied. We've created what looks like a higher low, and now we're trying to push higher. So certainly, if we start to break up through your 1.218 level, then all of a sudden you're creating higher lows and higher highs, really feeding into the notion that this bullish trend is coming back into play. So I think the bulls do come back into play. I think if we see that strong inflation metric coming out as expected, if we see the RBNZ holding off as expected, it does provide the basis for an expectation that we see more of the same. And this has been a great chart to be trading, very consistent. The fact that we're coming into this crucial week following a week of declines, in my mind, looks like a potentially strong setup for traders. And then finally, we've of course got to touch on what's happening over in the Middle East. Once again, so this is updated on last week's metric, and we've got another decline in terms of inventories. So we're seeing a major drawdown in terms of global inventories. US inventories are now sort of taking a toll, but they're seeing record exports over in the US. So they're making a lot of money, the US. They're benefiting from this, and that could be problematic when it comes to drawing a line under the wall, because the US isn't necessarily suffering to the same degree as many of the other countries around the world are. So they'll probably have greater patience and willingness to drag this out compared to the others. So we're seeing a sharp decline in terms of inventories. As you can see here, the biggest US inventories decline on record, but the US isn't the only ones essentially drawing down inventory. So the world's trying to mitigate this crisis and trying to hold off on allowing oil prices to surge higher. But certainly as those inventories draw down, that not only creates a position where at some point some of those inventories just become depleted. The US still has a huge amount of inventories. But also bear in mind that is a huge amount of future demand that comes into play as well. So that sort of puts a new line under oil prices in the future, because you're going to see these countries, as soon as oil prices drop back, having to top up these reserves once again. Now, we have seen Rubio saying there are some good signs. Look, quite frankly, on a daily basis, you're able to find a huge amount of conflicting reports saying that it's going well, or we're about to start the military conflict again, you know, back and forth, back and forth. I would say that my experience throughout all of this is that anytime you hear something good, it's generally a time to fade that. And if you hear that they're on the edge of a massive crisis, like they're going to bomb the bridge, the power plants, you fade that as well, because none of it happens. Yeah, maybe it will happen next time around, but the US has a lot of threats, a lot of bluster on the military front. They seemingly don't want to get back involved militarily. The Iranians, of course, are constantly pushing back on any of these claims that they're willing to allow their nuclear material to leave the country, despite the fact that the US are coming out and saying they're making great progress. So it's a bit all over the place. All we see is really choppiness. And whilst we do see some indications, like Rubio saying there's some good signs, I still feel like there's some really key issues that it's going to take a while to flesh out. In terms of price action, really, we're looking here at Brent crude, and we can see that essentially we've pulled back at the back end of the week just gone. And so we're kind of stuck within this sort of almost symmetrical triangle. Now, this sort of highlights the fact that triangles don't have to look all that pretty. In actual fact, the top end is pretty pretty. Let's see how pretty the bottom end is. So what I was going to say is, you know, the sort of construction of many of these different formations are based on highs and lows, swing highs, swing lows. So they don't necessarily have to all match up in terms of lines to tell the same story. So a symmetrical triangle just essentially is lower highs and higher lows. We're seeing exactly that here. We're pulling back. Do we respect this sort of prospective trend line? Potentially. But I do think we continue to see more of the same, where we're seeing sort of pessimism in terms of oil, where there's hopes of a deal, and suddenly they'll say that there's, you know, no progress whatsoever, and that they could suddenly bomb the opposition, blah blah blah. You know, it feels like we're going around in a circle. It feels like Groundhog Day at the moment, and therefore, as it stands, I just expect more consolidation. The pullbacks, the periods of optimism that there's going to be a deal seem to be relatively short-lived, and then the periods where it feels like we're suddenly about to see a massive escalation, they also become relatively short-lived. So I expect more of the same, really, and I think it's a case of just tracking it on the hourly time frame. So you can see here, sort of we pull back, we create the new higher high, we create the new higher low, you know, so then we set on our wave, then we break through your swing low, create a new lower low. That means the next one's a lower high. We drop into a new lower low. That means this current move is likely to be a lower high. Then we probably come back into this area. At some point, we then do this again. We break up through the price swing high, and that marks the new turnaround point. So, you know, it is relatively orderly, but it is news driven, and it is sort of consolidation. But we do see a relatively orderly construction, and we are seeing plenty of movement. So it is a good market to be trading at the moment. So keep an eye out for Brent crude. I can't tell you whether they're going to suddenly agree a deal or not, whether we're going to suddenly see a military escalation, but anytime you feel optimistic or pessimistic, they turn around. So it's a crazy time for traders, but like you can see, if you move into the right time frame, sometimes you can find something that sort of looks relatively orderly in all of this mess. I hope that's been useful for you guys. Make sure to like, subscribe, and follow for more content like this here at Scope Markets. My name is Josh Mahony, Chief Market Analyst. Have a great day, great weekend, and a great week ahead. Thank you very much.